The next lesson will be understanding credit. Now, from all the previous lessons, you should have a good understanding of credit, but we're going to review, we're going to talk about some things that you need to be aware of. Okay, so what is open-ended credit? This is revolving credit like your credit cards, which means you can build up a balance and pay it off, build up a balance. A home equity line of credit is also considered revolving credit. These are things that you use and then pay down, whether it is cash or whether it is credit cards. It is considered a revolving credit account. What is APR, or annual percentage rate? Annual percentage rate is the amount that you're going to be charged annually. That doesn't mean monthly. What it is whatever, if it's a 12% annual credit rate, which means it'll be divided over 12 months payment, therefore it would be 1% per month of the amount of the loan. As you pay down principal of it, and certain simple loans, that annual percentage rate stays the same, but the payment then can decrease. The amount that you're paying of interest decreases because the principal that you're paying on. So annual, it can be anywhere from 4 or 5% for mortgages, up to 21 to 28% on credit cards. So that is considered annual percentage rate, and these are how loans are. You'll see an APR, which is the annual percentage rate of the loan. The finance charge calculations, and what I've done on the website is put up all types of spreadsheets to use to figure out what the finance charges are. And these varying depending on the average daily balance, it could also be monthly and so forth, of what you are paying on. The faster you pay it down, in some cases, your finance charges will then move more towards the principal, which is the amount of money borrowed, and lower your overall interest rate. Now, with a mortgage, there's a thing called amortization, where you pay all of the interest at the beginning of the loan and let more towards the principal towards the end of the loan. That is only in a mortgage situation. Most car loans are simple interest, which means you're paying the principal, certain principal, and a certain amount of interest that's spread out evenly over the loan. But if you pay the principal down faster, actually your interest rates will be lowered equally. What is a grace period? Well, the grace period is the day from which the loan payment is due until the day it becomes late. So many mortgages will have a 15-day grace period, which means the mortgage is due on the 1st of the month, but you won't get charged a penalty till the 15th of the month. That does not mean that you won't get charged interest over those days, because you will get charged interest over those days. So a grace period is just a period that allows you to make payments onto the loan. But remember, you may not get penalized for that, but you may in fact pay more interest over that time. What are annual fees? Well, many credit cards have annual fees on them. That means just to have that credit card, you have to pay a fee to the credit card company to use their credit card. Because there's such a great amount of competition, when you have good credit, you're less likely to have credit cards that have annual fees. And these are things that you can negotiate with credit card companies. You can, if you've been a good client for a few years, you can call up and say, you know what, I don't want to pay the annual fee, and there's a lot of other credit card companies. Can you waive it? Sometimes they will, sometimes they won't. But if they don't, you have the choice. Now, this is only when you have good credit. If you have bad credit, they're not going to waive the fee. They may waive it, but very unlikely that they will. And then if you don't, you threaten them with getting rid of the credit card or closing the credit card. That's just going to hurt your credit. So quit using the credit card, but you're going to end up having to pay the fee either way. But worst case scenarios, try to negotiate it. Maybe you can get it paid off, taken off. What's a minimum payment? This just depends on the credit report and the lender's policy. It's a minimum amount you must pay on a loan each month. So if you have a balance, it may be just the interest payment. It may be even less than just the interest payment. But remember, that interest then goes towards the principal and compounds, and you pay more and more and more. So a minimum payment is the minimum amount that the loan company wants. It shouldn't be the minimum amount that you pay. You should always pay as much as you possibly can, at least all of the interest and some of the principal if you can, because that interest will get then compounded onto your principal and cause you to be either overdraft and then you catch an overdraft fee, or over the limit fee on a credit card, or pay interest on interest, which is a great thing if it's working for you in compound interest, and a terrible thing if it's working against you. What's closed-end credit? Well, it's a type of credit where there's a fixed amount of money that's specific for a purchase for a period of time. So if you went to a bank to get or a credit union, a mortgage company or whatever, to get maybe a home equity line of credit, they will only give you a certain amount of credit or a certain amount of money. And in that sense, then you must make, monthly payments for a certain amount of months or years until the loan is retired. So you don't get, this is not the revolving credit, this is closed-end credit. You borrow $10,000, you must pay $500 a month for 5, 10 years, whatever it is, until it's paid off. You don't get to borrow more money on it like you do with the revolving credit. You only get a certain amount up front. You make those payments until they're paid. And these, you really need to pay attention to this, because we're going to talk about truth in lending, but all of this stuff is disclosed in your APR and finance charges in your truth, because of the Truth in Lending Act. So make sure you read the contracts in detail. Okay, and what we have is secured versus unsecured credit. And secured credit means there's a deposit there, or there's some type of collateral, as opposed to unsecured credit, where they're going to borrow you money with no collateral, or no money in the bank, or nothing to save it. And if you can't get credit at the first, you're usually going to have to go with something secured, because the bank wants to protect itself. If you have good credit, you can go with unsecured, because you are known as someone who has good credit and is responsible. So that's another importance of secured versus unsecured credit, and understanding the two differences. But these are some things you must know when you're understanding credit. And another thing, whatever it is, I know it's in small fine print because they don't want you to read it. Read everything. If you get yourself into a position where you need to do something, that your back's to the wall, that's what they want. So make sure you save money, you build up good habits like the earlier steps. So if you're reading something and you don't like what it looks like, make sure that you understand it so you don't have to do it. Because here's an example: you can use your credit card and they'll give you 15%, and then they'll say, well, you can take cash out on your credit card, but they charge you 25-30%. Be careful. And then the scam part is until you pay it off, usually you're only paying off the credit first, and then the cash, the amount you wanted to borrow, second. So they put that on the back end of it so they can continue charging you those outrageous interest rates. So make sure you read the contracts in detail, and if you don't understand it, don't sign it until you find out and have someone explain it to you, and not the loan officer, not the credit card company, someone outside of that to explain it to you. All right, I will see you tomorrow. These are some things to look at and read. Do as much reading as you possibly can on credit, and understand money, finances, and credit as well. All right, thank you, and I'll see you tomorrow.